Broadcast is now starting. All attendees are in listen-only mode.
Welcome to our 2018 webinar series. In case you didn't know, 2018 marks LLIS's 20th anniversary. Each webinar this year will involve the number 20. Included in each webinar are advisors' requests for specific information from the 2017 webinar surveys. So watch for a question you may have submitted. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. Today's presenter is knowledgeable in a wide range of solutions here at LLIS. He's constantly monitoring the insurance and financial services industry to ensure your clients are getting the most up-to-date recommendations. He joined LLIS in 2003 with his CFP and MBA and has been leading LLIS as President and CEO since 2013. And here's Mark Maurer.
Thank you, Claudia, and thank you everybody for tuning in. It is the last webinar of the year, so just wanted to say thank you to everybody for tuning in all year, and hopefully we'll end on a high note. And this is, again, something that probably for a lot of you isn't in your day-to-day activities and day-to-day things you're dealing with clients, but some of your clients are going to ask you these sorts of questions, and it's neat that you are able to at least have a big picture overview of things to consider, especially if they may bring you existing policies and say they're designed for A, B, or C, and we can say, look at them and see how they're working in their overall business plan. And let's get down to business. Ooh, that was rough. Okay, 2003. That's me. Look at how young I am. Wow, I really do look young. Well, 2003 was when I started working in LLIS. And so part of along the way is I was part of the succession plan. How is LLIS going to keep working with advisors and clients for the long term? And so part of any good business is having a succession plan. That was me. And along the way, there's different things that happen, buyouts, shares are transferred, all of those things. But along the way, we also look at insurance and how we can use insurance to help facilitate or protect that transition from one business owner to another. And so we're going to look at how you can use, maybe we have used business life insurance and business disability insurance. So let's talk about life insurance first. Usually there's a few less flavors or options, and so life insurance I think sometimes is a little easier to understand. So when we talk about a buy-sell, you have, we're talking about using insurance to fund a buy-sell. It's words we use fairly regularly. Well, the buy-sell is actually the agreement. It is the contract, and it's a contract that says Party A agrees to sell to Party B if something happens, and Party B agrees to buy from Party A, or actually Party A's estate, if this certain thing happens. Within that, you can build in valuation, pricing assumptions. And so the buy-sell is actually the contract. It's a contract that says what's going to happen at certain events. But then we can use life insurance as the funding vehicle to make that happen. Because many times, if you had a situation where the buy-sell comes into place, you have a business partner who's deceased, especially when we're using life insurance. And if it's a fairly large business, well, that deceased owner's share might be pretty large. And so where are the other owners going to come up with the money to buy out that deceased partner's estate? If the business is worth $50,000 and there's 4 owners, everybody may be able just to fund it themselves. But if we're talking businesses of hundreds of thousands of dollars or millions of dollars, then we can use the life insurance as the funding vehicle to fulfill the buy-sell agreement. So what are considerations when we look at the types of life insurance to fund the buy-sell agreement? The first one is time. How long does each owner plan to stay in the business? Probably the more common, or the one that you'll see or that we're used to, is something like there's an older owner and a younger owner. And I'll use 2 people because it makes it a little simpler. But older owner says, I've found somebody who I'd like to take over the business. They've already bought in and own 5% of the business. Older owner says, I'd like to be out of the business within 10 years, or maybe even 5 years. That gives the older owner time to work with existing clients or customers, to introduce to the younger owner, and have sort of a gentle transition from one person to another. So that's probably more common, is that by the time we get to a buy-sell agreement, somebody's already decided, well, they want to start selling or start the transition, and there may be an end date. Other times, and this may work more so in your firms, is that maybe there isn't any particular time. There may be 3 or 4 young planners and you all have a great business going. No one has any particular time frame when they're going to be gone. And so you have longer term policies. For our first one, older person sort of effectively transitioning to a younger person, short term life insurance coverage. For younger planners in late 30s, early 40s, that's probably 20-year term, because there's no immediate plan for any sort of transition or buyout. It's protecting it for the long term while everybody's still working. And then I've even worked with some advisors and their clients who may have a family business where one owner says never wants to sell. It's usually a dad or a grandpa who says, you know what, I always want to keep 25% of the shares. I'm going to make sure the other 75% gets to my kids or my grandkids or whoever is running the business, but wants to keep some control, keep some percentage. And so then we might have a permanent life insurance need, especially again if it's a fairly large company, that the surviving owners have the ability to buy out grandpa's or dad's estate if they want to do it with life insurance. So those are sort of the time considerations. How long is that owner going to be in the business? How long does a business need to be able to buy the owner's shares back from his or her estate? And then the amount. So you have time, how long do you need the coverage? But then the amount, how much coverage do you need? So you look at, who are we insuring? The person, we're looking at how much they own today. 4 younger planners, each owns 25%. Sake of argument, let's make it a $2 million business. Then they each need a $500,000 life insurance coverage. But we say, well, Mark, the business is growing. We've been growing by 8% every year. Okay, now we can factor in some growth assumptions so that don't have to rewrite insurance policies every year or two, so that we don't have to go through the underwriting and all of that every year. Insurance companies understand that businesses grow, and with a track record of growth, they're pretty flexible in saying, okay, the business is worth $2 million today. In 5 years, we expect it to be 3. And so we'll consider each owner for $750,000 in life insurance coverage right now. If the business has been growing by 20 or 30%, well, probably couldn't get 8 or 9 million per person. There's some factors there just to see what's sort of a reasonable or sustainable growth. And so I talked about ownership, share today for younger planners, it's probably 25% indefinitely or an indeterminate period of time. With my first scenario, older planner, younger person coming in, then you have a shorter buyout period. You also can do things like layer some term coverage. Maybe it's $1 million business and the older partner plans on being out in 5 years or 10 years. Then maybe we do something like ladder two 10-year, $500,000 term policies. So if something happened to the older owner today, there's the $1 million to fund the buyout. But in 5 years, halfway through the buyout, then in theory, the older owner has already had 50% of shares transferred to the younger, so the need for the life insurance in 5 years is only $500,000 if the older partner was to pass away. So all things that we're working with you to help determine what's a good fit. And lots of times you'll come to me with clients that with policies that your clients already have, and I'm not sure that any of this has really been done. Might have a short-term buyout and somebody's used whole life. High premiums, little to no surrender values, and designed to actually, be to go to age 100, 120 and actually have growing death benefits. So almost everything can be exactly backwards. So those are the sorts of things that are fun to dig into a little bit to make sure that either what they have or what we're looking at all make sense for them in their particular situation. And I am not an attorney, so I'm not really going to talk about contracts that much. I'm not a CPA, so I'm not going to talk about taxes that much. But in an overview, there are generally two types of buy-sell arrangements. And you can have a stock redemption or a cross-purchase arrangement. With a stock redemption, the corporation owns the life insurance policies and is the beneficiary of the life insurance policies. So from that standpoint, it's a little more simple than the cross-purchase options we'll talk about in just a second. So at death of one of the owners, the corporation buys the stock from the deceased owner's estate and then redeems it. And so to the surviving owner, his or her basis is unchanged, but his or her ownership percentage increases. So if there were 100 shares outstanding, one owner dies, then the life insurance comes into the business buys the deceased owner's 50 shares, but then redeems them. Now the surviving owner still only has 50 shares, but it's now 100% of the outstanding shares. So in this case, stock redemption, the survivor doesn't actually get the other 50 shares. They still own just 50 shares, but now that's all of the outstanding shares. And so a benefit to doing stock redemption is that it's all corporate money. So the premiums are paid by the business, the life insurance, if needed, if it passes as a death benefit, comes into the business. So from that standpoint, it's again a little simpler. There's no employee tax on the premiums paid or anything like that. And the simplicity of it is that there's one policy per business owner. So that's, I think, what makes often stock redemption attractive. Now let's look at a cross-purchase design. And here, each owner takes out a life insurance policy on the other owner. So where in stock redemption, the business owns the life insurance policy, in this case, the owners own the policy on each other, and they pay the premiums individually. If one of the owners dies, then the insurance proceeds pass tax-free to the surviving owner. And because of this, now the actual owner buys the surviving owner buys the deceased owner's shares. So now the surviving owner gets an increase in cost basis to the full purchase price of the deceased owner's shares. So in this case, Mark passes away. Judith has a basis in her 50% ownership, and now she gets full cost basis treatment of the other 50 shares that she purchases from Mark's estate. And it works really well when we have two owners. Why? Well, Judith needs to own a policy on Mark, and Mark needs to own a policy on Judith. There's only two owners, so it's only two policies. Let's have an example. Here we throw my dad Keith in the mix. So if there had been three owners, now we need 6 policies. Judith has to own a policy on me and on Keith. I own a policy on Keith and Judith, etc. So all of a sudden, instead of 2 owners, 2 policies, now we have 3 owners, we have 6 policies. If we did a cross purchase and had 6 owners, how many policies would we actually need? It's going to be 6 policies. You don't own a policy on yourself. So 6 people need to own 5 different policies. So now we have 30 life insurance policies floating around. Wow, that starts to be an administrative nightmare. Imagine if we added another owner. It's going to get pretty crazy pretty fast. So that's one reason why the entity purchase or stock redemption version of the buyout, I think, is attractive many times. The more owners you get, the harder it's going to be to make that work administratively. What are some other considerations? I have never worked on a buy-sell arrangement for identical twins. Why would that matter? Well, identical twins are the same age, and we're going to assume that they're in the same health. So each twin's policy should cost the same. So there's no disparity in premiums. Each pays the exact same premium because they're exactly the same age, exactly the same health. So there's no difference to either owner. As of yet, that is not to happen. And if it does, it will be a great case study the other way. But because it hasn't happened, here's the considerations. When you start to do things like cross-purchase, and we have one older owner and one younger owner, it may be tricky because now the younger owner is paying the premiums and the younger owner probably isn't making as much as the older owner. The younger owner has to pay premiums on a larger amount for the older owner who owns most of the shares, and older rates, and maybe not in great health. So you can get quite a bit of disparity there between what the premiums are when we start talking about the ages and health of owners. Again, if it's 1 to 2, well then that just may be the one of the arrangements for the younger owner buying in. If there's multiple people, again, sort of another reason that the stock redemption or entity purchase plan makes sense sometimes. Multiple people, multiple ages, multiple health. When the business owns the policies, they're just an expense of the business factored in with everything else like rent and printing new brochures. And at the end of the year, it's just one of those expenses after you've paid everybody's salaries and things like that. So cross purchase, again, works very well if there's only 2 owners and tend to be in fairly similar ages and health. The other thing we can look at with life insurance is key person insurance. And sometimes the owner is going to be the key person. In this scenario, is really not. this is, now I'm talking more so somebody who's not an owner, the life insurance isn't needed to transition ownership or shares, but really just how does the business operate if that key person was gone? And only 1 in 5 business owners have key person life insurance. And so we, have insurance on our office furniture, on lots of different things. If we have one person or 2 people who are really key to making our business run, then it may make sense to have insurance on them to protect the business as well. So the key person normally has critical skill sets. So it may be an IT person. It may be a particular portfolio manager. I can make up all kinds of things. Somebody who, if you sell mostly widgets to Mexico, somebody who speaks Spanish is a critical skill set, and somebody who really understands how you make your widgets and can speak Spanish is very valuable. Generally, this person may or may not be the owner, and here I'm really going to say they're not the owner. This is key person as sort of a standalone thing, but they often are responsible for management decisions, generally highly compensated. If they're not highly compensated, it's hard to say they're particularly key to the business, have a significant impact on business income, and many times have special rapport with customers or creditors. So people who help the business run and run well. So having the key person life insurance, it protects the most valued asset, not our desks, not our computers, but the people who generate income for the business. Like the sort of the entity purchase, it's business owned life insurance, the business is a beneficiary, and if the key person dies, well, then the business gets that life insurance and they can use it to recruit other people. They need to hire headhunters who can find people who are fluent in Spanish and know everything about the newest widget design. Promote people from inside to take over. May need to promote 2 people to cover one person's job, but pretty soon they'll be up and running. Retain, again, just if a key person leaves, it's great to have some operating income, some income there so to continue operations. The premium isn't deductible, so it's just an expense. And it's usually term because it's usually just in case the person passes away, then the business has this money to do those things, recruit, promote, retain. But we can do a little bit more and can combine the life insurance into an employee and employer benefit. One way to do that is by creating a death benefit only plan to insure a key employee. So with a death benefit only plan, the company is owner, payer, and beneficiary of the life insurance policy. When somebody asks, is the key person life insurance premium for the owner deductible? So no, it's not a deduction, it's just an expense. So the company is owner, payer, and beneficiary of the DBO plan. And so in this case, the actual employee is the insured of this life insurance policy, but doesn't own it. And so the arrangement or the agreement is this plan between the employer and the employee. So the employer agrees to pay the employee's estate some amount. We'll talk about what that might look like. But usually it's some level of income for a number of years. And the plan terminates at retirement or separation. So you can always make it more generous, but if somebody retires, you may want to do something with the policy. Maybe give it to them if they want to keep it as their own. If somebody leaves, you probably don't want to. But the employer is the one who's on the hook. What do I mean by that? Let's say you sign the agreement and everybody signs the agreement. Now, if you didn't have the life insurance, if the employer didn't have the life insurance, didn't fund the life insurance, let it lapse, the employer still says we agree to pay the employee X amount for X number of years. So they're still in agreement. The life insurance is what makes it easy for the employer to fund the agreement. To the employee, like I said, they don't have really any part of the life insurance policy. So they don't own it. They aren't a creditor to the life insurance policy or anything like that. So because the employee has no ownership of the life insurance policy, they're taking a little bit of faith with the employer. But in trade-off for that, there's no income tax or any sort of interpolated benefit to the employee either. So here's John. He's age 39. There's our employer. Got his cup of coffee. Well, John, you know what? He's the best darn computer guy there is. And every time you get the blue screen at death, or your font looks too big, or your font looks too small, all of those things, John's there, and look at him. He's so happy and smiley. He's even happy to help when your font's too big or too small. And Mr. Business Owner over there says, you know what? He's great. I really want to keep him around. I know IT people are in need, so I kind of want to have something that keeps him here, something that makes it so he doesn't really want to leave. What's something I can do that's extra for him that maybe I don't do for everybody else? And so he says, you know what? Let's look at one of these DBO or death benefit only life insurance plans. And he says, John, you know what I'll do? I'll pay your survivors $100,000 for 10 years if you die while you're working here. John says, wow, that's great. Look, Mr. Business Owner, man, he's such a nice guy. I don't want to look for a new job, which is exactly the goal here. So how do we do it? Well, we use life insurance. And in this scenario, I'm just going to look at $1 million life insurance policy. And you say, well, how does that really cover the key man part? Well, the company is going to get $1 million life insurance policy, but the business also then only has to pay out John's estate $100,000 each year for 10 years. So the business really has the use of most of the money for the 10 years, and as it's being paid out, then hopefully you're able to use some of the money to hire a new person, do all of that. So probably using some of the death benefit just as a cushion initially, but over the long term, we'll be able to pay it all out. So do we use term insurance, term with return of premium, or low load UL? Well, there's all kinds of options. So we're going to use $1 million policy, and we're going to have a 30-year premium schedule. So if we do 30-year term, it's guaranteed. We know exactly what it's going to be. $1,235 a year, not $12,000. If we do a 30-year return of premium term, premiums can be a bit higher, $3,010, or a low load UL, and we can sort of design it how we want, and that's going to be $3,000 a year. Remember, we said the death benefit only plan has, the employer is agreeing while John's there, but if John decides he wants to move on, well, then there's no part of that agreement anymore. It just goes away. So what happens in 10 years if John says, you know what, I found a better job in the Bahamas? Says, I'm gone. Okay, well, now the agreement is null and void. So the business has been paying these premiums. In 10 years, if they had the 30-year term, there's no cash value. They just stop paying the premiums. With the return of premium term, about $6,400. And the way return of premium term works is that usually for the first 5 years or so, there's no return of premium term, no return of premium, or no quote-unquote cash value there. The return of premium on a return of premium term looks a lot like a hockey stick. And being in Florida, it took me a long time to figure out exactly what a hockey stick looks like. We don't know hockey. And now we have the Tampa Bay Lightning. I know more about hockey than I ever thought I'd know. But it looks a lot like a hockey stick. Little to no cash values for a while, and at the very end, it just really takes off. So in year 10, if you had the return of premium term option, could cancel it after 10 years, get $6,400. With a low load UL though, paid in $30,000, can get back $29,000. So it's a really neat option for some flexibility there, especially because we don't know exactly what John's going to do. We're talking 20, 25, 30 years. So it adds a nice level of flexibility there. Look at the year 20 cash values. Had it for 20 years and John decides to leave. Probably wouldn't after 20 years, but maybe he does. Got a lot more cash value. The business is able to recoup a lot more of its costs with the UL than with the return of premium term, and especially the straight term. So the low load UL option, it gives the most flexibility if John leaves. The term has the lowest, a straight term has the lowest premium. I mean, it really does. It's just a check, it's an expense. The low load UL, it has a higher premium, but there's cash values there. So the employer can cancel the policy and get money back. The company balance sheet shows the assets of the cash values there. So it's an asset on the books. You're basically taking some money out of the checking account and putting it into cash value in that life insurance policy that's now an asset of the business. And the cash values in that policy can be included in AUM. If you're working with the clients managing other things, you can include the cash values of that policy in AUM as well. So, talked about life insurance for a little while. Now, let's jump on to business disability insurance. So there are 4 types of business disability plans, and we're going to delve into them a little bit deeper. One question came up, which sort of coverage do we have here at LLIS for our buy-sell? It's a little bit of both. So we do have some term on me, and we do have some of the low load, no commission, universal life policy too. So we did a little bit of both. It's kind of like all things we want to do. Try to not have all our eggs in one basket, do a little bit of column A, a little bit of column B, and helps sort of across all things. So what is the plan? We have business overhead expense, BOE with business loan protection, key person disability, buyout coverage, and different occupation classes. You can get different types of coverage. Really here you look at key person. Again, key person is designed to be a little bit more the higher occupation classes. You can do buyout or BOE down to an occupation class A, so probably more manual duties. Key person, the business loan wants a little more sort of office type work. This one just shows where key person coverage is and isn't available. So Florida, it's not available, unfortunately, which is why we don't have key person disability coverage on me. It's not available in Florida. So what does BOE work for? Fee-for-service businesses of 1 to 8 owners, other businesses 1 to 4 owners, but provides a benefit to the owner to pay the monthly expenses of operating the business. And the reason you would do this is the loss of the owner would incur a significant loss of income to the business. So my best example is a dental office. You have Mrs. Dentist. You have 2 hygienists. You have the office person who makes the appointments. So you have 1 dentist, 3 support people. If that dentist can't work, well, then I don't think the hygienist can see anybody. They might be able to, but can't do much. Have to be able to pay the office person staff. So that 1 person has a significant impact on the ability for that business to operate. If there were 7 dentists, then BOE still might be good to have. It would help offset costs, but if 1 dentist wasn't there, the other 6 might be able to take on his or her patients sort of easily. So that's sort of the difference where BOE makes a big difference. This is on our website. It's a neat little chart about things that business overhead would cover. Business overhead is a reimbursement type plan. So it covers certain expenses, and this chart is good to sort of add it all up, what the business's rent is every month, any business loans, fees for accounting fees, salaries. Salaries is the one thing that's a little different. Salaries is for generally anybody not sharing the owner's um, occupation. So in my example, the dentist and the hygienist and the office person, the salaries would cover not the dentist salaries, but what are the salaries of the other people, the support people. So that's sort of the number that goes into there, the employee's expenses. BOE plans, maximum of $30,000 a month. Said their reimbursement. There could be multi-life discounts when bundling them with other, like an individual policy. Dentist needs his or her own disability policy, can add BOE coverage and get discounts. Most insurance companies have those for multiple policies. The elimination period is fairly short. With individual disability, we can go to a 180-day elimination period often. BOE is a short elimination period because these are the expenses that have to be paid. Your hygienist and your office person aren't going to stay around the business very long if they don't get paid. And so short elimination period because the bills keep coming in. They aren't going to delay for 6 months. And the benefit period is fairly short, 1 year to 2.5 years. It's designed to keep the business going for a period of time until something can change. It's not designed to keep a business going indefinitely because it doesn't really make sense to have a dentist office with no dentist, but everybody's getting paid for the next 10, 15, or 20 years. So it's designed to be a short-term way to keep those people there so that either there's a business for another owner or another dentist to come into if the disabled dentist knows somebody, can bring him or her in, can sell it to somebody, and there's already staff, equipment, things like that. So it's designed to keep the doors open for a period of time and not have everybody scatter. Somebody asked, does the BOE also have various types of definitions like own occupation or any occupation? Yes. So the BOE plan, probably the basic, you couldn't see me do air quotes, but basic one that we would look at is a your occupation or a modified own occupation. None of the ones that we would look at would have the any occupation up to the sort of the true own occupation definition. Good question. You can add a business loan protection rider. So in addition to all those other expenses, maybe the dentist had to buy a bunch of new dentist chairs or the really cool light things on the handle that they use to look in your mouth. I'm guessing those are expensive. They look really fancy. So she had to take out a loan to buy the new overhead mirror light things. So you can add this on as a BO. You can add this on to the business overhead expense policy, and it's a sort of a separate line item for these different types of loans. So for the BOE, it's $30,000 a month maximum. You can add this as another $20,000 a month, up to a $2 million aggregate. And again, it's a reimbursement type plan. Either the insurance company reimburses the owner after seeing that they've made the payment, or this can be assigned directly to the lender to make the payment as well. And it can be taken out during the loan processing. And I would imagine that a lender would be more likely to make a loan, make an offer, improve a rate if you could show that, hey, in case I can't work, I've got this policy here that's going to continue to make the payments for me. How long does it last? Again, sort of kind of like the other policies, not really to age 65, but it's to the end of the obligation or 3 years, up to a 30-year maximum. So, but it won't exceed the loan. It cannot exceed the loan termination date or age 65. So really, it's sort of a nebulous number But like I said, it's a reimbursement type plan, so it's nice to have on that business overhead policy if someone took out a fairly large loan. We can add longer elimination periods to this, just for that section of the BOE plan, just for the loan protection rider. Key person disability works a lot like the life insurance, except you're disabled, or the key person's disabled, not dead. So the employer is the policy owner, pays the premium, insures the key employee in the event of total disability. And sometimes both of these things are taking place at the same time. The owner is looking at this key person saying, yes, if they're deceased, obviously that's a risk to me. But what if they just can't work? Really, to the business owner, that's the same thing. If they're not here working, both of those are an issue to me. Both of those are an impact. So the insurance company pays, if that key employee becomes disabled, the insurance company pays the benefits to the employer if the key employee becomes totally disabled. Have to have a minimum income of $30,000. Again, falling into that theory that your key employee should be highly compensated. And the benefits can be paid as a lump sum all at once. It can be a monthly benefit, combination of both. Many times if you have someone with a contract buyout, you might see something where the key person plan pays X amount for 12 months, and at the end of the 12 months, then there's a larger lump sum. So it really just depends on the arrangement with the key employee. Age 55 is the maximum issue age. So just wanted to put that out there. Can have number of benefit periods as well. So again, like not designed to, sort of like the BOE, it's designed to help, to be a cushion, but not designed that the business could, in theory, continue to pay somebody's salary till they're age 65. That's what individual disability is for. The key person is designed to have this cushion where the business has some operating income capital to be able to say, we need to hire somebody, and have this sort of be able to offset some of those expenses, maybe while the new person is getting up and running but isn't quite there yet. Now we're going to talk about buyout. So if the business, how about disability buyout coverage? Generally for businesses with 1 to 4 owners, small businesses, 5 million or less in revenue. Surprisingly, the buy-sell agreement is not necessary at the application. Actually, only about 18% of succession plans are funded with disability buyout. So there's a big concern there, because it's all the statistics out there that disability is much more likely than death in our working years. And so it's a bigger gap in the overall plan. In order for people to be eligible, they have to have a minimum ownership of 10%. The BOE, the buyout policy, it can pay the buyout benefits in a lump sum, monthly installment, or combination. So it can be a lump sum out to 60 months or 5 years. Maximum is $3 million. The buyout elimination period, well, this is the first time where we're seeing really long elimination periods. Can actually be up to 2 years. If you have a buy-sell agreement, if somebody dies, well, then that's sort of an instant trigger. They're really not coming back to work the next day. That's just a fact. So you would want the buy-sell to trigger immediately at someone's death. However, if somebody's disabled, a lot of people may be out of work for a while, but come back. It may be a little while, maybe a long while, but you wouldn't necessarily want your buy-sell agreement to trigger, again, the day that somebody becomes disabled, because that owner may be out for 3 months, 6 months, maybe a year, but then might come back. It might even be bigger, faster, stronger after a year. So your disability buyout tends to have a longer elimination period. You don't want it to be just 90 days, because a lot of people may come back to work after 6 months. May not be full-time, maybe part-time, but that's why with the buyout, we have these longer elimination periods, even up to 2 years. So you want to make sure that there's not a possible recovery way for the owner to return back to work, because really the disabled owner is giving up all of his or her shares of the business. So you want to make sure that there's time for him or her to be able to come back to work. Benefit periods, shorter. Again, can't go to age 65, because again, most buyouts probably are going to be negotiated or set over a period of time. And non-related owners probably don't want to say, sure, let's pay me out my shares over the next 30 years. No, I want to be fairly short term. So here's an example of marketing advertising firm that we worked with an advisor and his clients with recently. And there's 3 of them: Earl's 57, Adam's 41, Cindy's 56, and started talking about disability buyout. And that's how excited they were. Wow, disability buyout. We think that's the greatest idea we've ever heard. Look at the excitement on their faces to talk about insurance. Sorry, had to do that. So the value of the business is about $3.6 million. And luckily for me, when I started working on this, they're all equal owners. So they looked at a disability buyout plan based on their buyout arrangement with a 1-year elimination period. And based on their buyout arrangement, they wanted to look at the lump sum buyout policies. So Earl, Adam, Cindy, $1.2 million disability buyout policy. Those are the annual premiums on the right-hand side, because this is saying that for the shortest elimination period, 1 year, and the maximum payment, lump sum, so a lump sum after 1 year, that the disability insurance company will pay $1.2 million to the business for the buyout for these people. And so Earl, age 57, Cindy, age 56, $22,000 a year. Now, when we look at the fact that it would cover a $1.2 million buyout, well, actually it doesn't seem that much. It's covering $1.2 million. But what did the client say when he saw the original quotes? Whoa. Okay, let's put the brakes on that. And not surprisingly, the first question was, Mark, this looks right, but how do we get the premiums down? Fairly simply, by moving from the lump sum payout to a multi-year payout. So the policy will still pay $1.2 million if the one owner becomes disabled after 1 year. But if everybody agrees to take the buyout over 5 years instead of a lump sum, saves about 50% of the premiums. Premiums are cut in half, saves about $26,000 a year on the disability premiums. So how do they do that? Again, I'm not an attorney, but I think pretty easily, if the 3 of them agreed, they could amend the buyout agreement that says in case of disability, buyout will be payable out over 5 years instead of immediately. Again, I'm not an attorney. It's probably more complicated than that. Probably takes a lot more words than I just used, but fairly, at least from my mind or my standpoint, fairly easy to adjust that. The owners still would get the $1.2 million. It would just be an over a 5-year installment instead of a lump sum, and saves $26,000 a year in annual premiums. So that part's really nice too. So we covered business life insurance, business disability insurance. If anybody has any questions or anything they want to type in right now, happy to go over any questions. I probably should have said that initially, to just type in any questions you might have, whether it's about this, about other things. Happy to chat about anything, any sort of insurance related things. It's the end of the year, so if you have any burning thoughts or questions about insurance that you've just been bottling up or holding in all year, feel free to go ahead and type those in right now. So I want to discuss, or do mention, that we're hosting our LLIS Academy here in Florida again in February. Insurance in your head, sand in your toes. And it's February, it's really on the beach. If you go to the website and look up the Sheridan Sand Key on Clearwater Beach, the first time I saw the pictures, I really thought this has to be superimposed and photoshopped. No, the beach really is that long. It really is that pretty. Not to sway anybody, but February and end of middle of February, then I can't promise that it'll be warm, but I can promise that it'll probably be warmer than where most of you are coming from. And we will have some guest speakers. We will have a speaker, Alan Gregoire, who has spoke a few years ago about long-term care, and he's great to listen to. We're going to have a claims person from Columbus Life Insurance Company to talk about sort of how they process claims, what are things they're looking at. We're going to have Judith Maurer talk about life settlements and charitable giving of life insurance policies. So we're going to have some fun things this year, and hopefully as many of you all as would like to could join us. So there are, at the end of the year, or at the end of the webinars, we like to talk about our top 10 things that make LLIS different. One is the free monthly webinars. They're CFP. They're Tuesday afternoons at 4. We haven't figured out what we're going to do next year yet and what we're going to work on, but it's just something that we do for advisors and CFPs, so you can make sure that you're getting all those CEs that you need to get. We're not your competition. If you're new to us, our only clients are fee-only advisors. We save advisors time and your clients money. One of the ways we do that is pre-underwriting to avoid surprises. We have a lot of tools for advisors and clients there on our website. We're proud sponsors of NAPFA, NAPFA Genesis, the XY Planning Network, Garrett Planning Network, and ACP. We have specialists in life insurance, disability insurance, long-term care, annuities, and the hybrid policies. It's either a life insurance policy with long-term care benefits or an annuity with long-term care benefits. And we're here today to help. One of the things that we do a lot of is, or I do especially, is policy reviews. If your clients have existing policies in any of those areas, life insurance, disability, long-term care, we're happy to review those for you and the clients. And we can give you an overview, sort of what they have. What's great about working with fee-only advisors is that you also know, by working with the clients, what they should have. So many times what they have and what they should have, or what you'd like them to have, aren't exactly the same. So we try to figure out, is there a way to repurpose existing policies, redesign them? Are there other policies that might work better? And try to do all of that for you and with you and for your clients. We help manage clients' policies in the future as well, and sending out notices to advisors and clients about their advanced premiums that are coming due, so policies don't accidentally lapse, and our notice of term expiration. You have clients who 20 years ago, 20-year term policy made the most sense for them. It's coming to the end of the 20 years, and is it still, what we hope that term policies do is we get to the end of the 20 years, they don't need it for income replacement, and we just let it go. That's the ideal is that it did exactly what it was supposed to do, and we get exactly to the end of 20 years, we don't need it anymore. But sometimes clients may need insurance a little bit longer. And so we look, can they apply for new coverage? If so, that might be make the most sense. If they have had a change of health isn't good, maybe converting existing policies, if that's an option, is something to look into. So those are the sorts of things we do with our notes. And we have Alice, our website portal. She's just over a year old, but have lots of things there for advisors, can see clients' statuses of applications, policy statements, things like that. I see one or two other questions. I will probably respond to those offline in the next day or two, maybe a little more detailed than I could probably do right now, but I will be back in touch there soon. And thank you again to everybody for tuning in. Thank you for this year, and it's our 20th year. We've celebrated our 20th year, so the theme was 20 years. Thank you to everybody out there, new planners who are starting to work with us, people who have been around for much longer than that, and to both of you, we thank you very much and look forward to 2019. Thanks.